Okay, and with that, my name is Jason Jones. I am a partner at Disruption Credit and co-founder of the Lendit conference. Disruption Credit is it's an institutional investment firm focused on the online lending industry. We're very good friends with Lending Club, and we're happy to be here hosting this conference today. So my agenda is to talk about basically what I want to say to you guys today is just kind of give you a reason why we kind of created the conference, give you an overview of some of the companies that are here, and give you just a summary of what's happening globally in the online lending industry. Okay, consumer P2P lending, old is new, bringing back the personal loans. This is actually an old segment that is brought back through technology. Go back to 1960, look at the survey of current businesses, and what you see here is a line item called personal loans that represented 20% of total consumer credit. You fast forward to today, they don't even list personal loans as a category by the Fed anymore. There's other forms of personal credit that are more dominant. Number one, credit cards. Number two, home equity lines of credit. But if you look over time, those two have peaked. They peaked during the financial meltdown, the recession. Credit cards peaked at $1 trillion. Home equity lines of credit peaked at $611 billion. And then they came down. So obviously why home equities came down, value of homes dropped, no reason to continue issuing home equity lines of credit. But the question I have is why did credit cards take such a significant pullback? It certainly wasn't due to a lack of interest. As you can see here from Google Credit Index, the searches for credit cards they're at all-time highs. They continue going up. So we know the demand is there. It's just that the supply has been completely limited. Why has the supply been limited? Obviously, we had the meltdown. You can see the peak there again. The top line represents total revolving consumer credit owned and securitized. What's really interesting, though, is the bottom line and the huge cliff that you see there. So basically what was happening is that banks were originating consumer credit and then securitizing it and selling it off. And you can see that that worked well for a while. And then all of a sudden, there was the meltdown. Then after the meltdown, there was regulation. In regulation, there was two specific accounting rules, FAS 166 and 167. And those two rules basically said to the banks that you're no longer allowed to securitize. Well, you can securitize, but beforehand, when you securitized, you passed it off of your balance sheet. Now, even after you securitize, it stays on your balance sheet. So all of a sudden, overnight, the banks had a lot more debt on their balance sheets. And as you can see here, all of a sudden, they have a ton more debt because the securitization is now factored onto their balance sheet. They're in burn-off mode. So due to both the financial meltdown and then regulation, banks are not incented to really lend right now. So what are your refinancing options? You have a ton of credit card debt. You want to refinance. What can you do? You look towards balance, and typical credit card debt is 18 to 22%. You may be able to find a balance transfer credit card, a personal loan from a commercial bank, or if you put up your home as equity, a home equity line of credit. The problem is that, as I just demonstrated, all three of those solutions are really kind of frozen or really locked up right now. It's tough to get those. In addition, the banks were mispricing, as Renaud was mentioning. The gap between of credit cards is obviously very small compared to the gap for every other type of credit over time. So you have a product that was dominated by the banks in a monopoly situation where it's the golden goose. They don't have any incentive to lower rates, to match. There was no alternative source of capital, so there's no reason to lower rates, and they've done well for themselves over time. It's a perfect setup for companies like Lending Club and Prosper and other P2P platforms. And this is what you can see. I'd say the reason for Lending Club and Prosper's success in the United States has been, number one, great use of technology, giving the consumer attractive rates and great use of technology. But number two, timing was excellent. With regulation and the meltdown, P2P loans were perfectly positioned to fill the gap of credit. So our forecasts say that this year we're doing about $2 billion in total originations in the United States. We think in the next few years that's going to scale to about $20 billion in total originations in the United States. And when we look at that in terms of the big picture, it's just scratching the surface. The total credit card balances outstanding are $850 billion in the United States, and consumer credit is almost $2.5 trillion. So if you think about that, it's $2 billion today, a few years, $20 billion. That's a 10 times return. If you listen to some of the stats that are out there, of the $850 billion of total credit cards outstanding, if you look at the prime quality borrowers, the variables that match those borrowers, that represents about $300 billion of assets. So even if we did grow to $20 billion, we'd still have 150 times to go before we get to $300 billion, which is the total addressable market. So really, when it comes down to personal loans, the question is, can they cross the chasm? Today, the personal loan market is not $300 billion. Maybe it's $40 billion or so, and P2P is $2 billion. So there's room to go there, kind of get the low-hanging fruit, and that's what's happening now. But once you get up to 10 billion, 11 billion, 12 billion, then you have to start to think, can these online marketplaces actually change user behavior? Can users start bringing back personal loans and actually thinking about them as an alternative source of capital? And we're not talking about the low-hanging fruit anymore. This is mass market adoption. That's the chasm. And I think the P2P companies will bump up against that. And then the question is, can they get to the next level? Can they get from the $10, $15 billion origination mark to the $300 billion origination mark? And that difference is going to be a change in perception of mass adoption from credit cards and home equity lines of credit to actual personal loans. And it reminds me a lot of the movie It's a Wonderful Life. It's really bringing back the community. And you're going to hear that a lot today. Bringing back the community. Lending for borrowing or one person depositing his money in the bank, lending to another person in the local community. That part has been lost, and a lot of the platforms you're going to see today really are focused on the community, bringing that connection, that one-to-one connection back. So global P2P lending, it's happening everywhere. The US is the largest market, $2.4 billion. There's 3 major platforms right now, or 3 platforms over $20 million. China, $2 billion in P2P lending, 400 platforms. It's a huge market. It's cultural there. The UK, $800 billion with 3 major platforms. Continental Europe's coming up behind, $100 million right now, 3 major platforms. So China. China has a shadow banking economy that is enormous, $5.86 trillion according to JP Morgan. The shadow banking economy is up 100% over the past 2 years and represents 69% of China's total GDP. Of that, there's all sorts of different, this is structural. This is both cultural and structural in China. Trust companies and wealth management products have taken the place of banks in China for a lot of at the local ground level. And in the P2P sector, which is about $2 billion, you have, like I said, about 400 companies, but there are a few leaders. CreditEase right now is the largest P2P lender in China. And we have Sino Lending here today. Co-founder, Sol is a co-founder of Lending Club. It's now started Sino Lending in China, a really interesting company. We have QED presenting later, a venture capital firm that's a backer of China Risk Finance. PPDI, backed by Sequoia, who's also presenting today. So we have some representatives from China here today. The UK market. This is kind of a bad graph, but basically what I'm trying to say here is that in the US, there is, once you get beyond the big banks, the US is the circle on the left. Once you get beyond the big banks, there are tons of small community banks out there. And that 64.8% is the other. The others, meaning the others other than the large banks. So there's a lot of market share for smaller banks in the US. On the right-hand side is the UK, which is dominated by 5 big banks. Once you get beyond the 5 big banks, there's only the other category is only 22%. So in other words, the UK market is much more concentrated, and that changes things pretty dramatically. The three leaders in the UK, Zopa, Funding Circle, and RateSetter, actually position themselves a little bit different than are positioned here in the United States. They're really focused on being an alternative to a bank. They talk a different language than we do here today. They talk about lend to save and provision funds, very focused on regulation and liquidity. When you invest over these platforms, they really care about having no losses. It's not, and returns are much lower as a result. So you're talking about platforms that are offering 5 to 6% yields with zero or very, very, very net default rates. Whereas here on Lending Club and Prosper, the rates are more like 11, 12% net interest rates with default rates of 2%, let's say. So you get a net return of 9% here in the United States. We're a little more comfortable with a default, and we're a little more comfortable with thinking of it as an investment. So over there, it's more a replacement for a bank. Over here, it's a little more investment. We'll see if that changes over time, but that's kind of how the companies are positioned now. Australia is very similar to the UK. 4 major banks that dominate every category of lending over there, and it really has been dominated forever over there. And now we have a company here today, Society One, which is the first P2P lender in Australia, tackling that market. So moving on to student lending, solutions for the student lending bubble. The red line is student lending. The other lines are home equity line of credit, credit cards, auto loans. Obviously, student lending is the only form of credit that did not slow down during the recession. It just kept going. It's very concerning. And what's really concerning is this chart. The red lines here represent the rates charged by the government. The government issues 93% of all student loans. And they're not risk-based pricing. Everybody gets the same rate on their student loan. It's either 7.9% or it's 6.8%. And the bars here, you can see, are the default rates. The for-profit colleges obviously have significantly high default rates. You go to a private nonprofit college, default rates are much lower. Yet everybody's priced the same. So if you think about this market, what companies like SoFi and Common Bond are focused on is, where's the mispricing? Can you refinance those that have great credit? So find the right colleges, refinance the right people at the right colleges at a more attractive price. So like I said, SoFi, Common Bond, which are both here today, are focused on setting up funds at each individual college and lending to the students at those colleges or recent alumni of those colleges. They're really alumni-financed funds. Pave and Upstart, Pave is here today, also focused on the category, but instead of kind of creating a fund and lending to a group of alumni, it's one-to-one. So the person it's kind of like a Kickstarter for people. The person kind of lists their occupation, where they graduated from, and why they want to refinance their student debt. You can actually lend to a specific person. Okay, small business lending. I was down at the Treasury with many of the people in this room about a week ago. There was a conference down there, and the chairman of Key Bank got up and said she lends to the small business segment, and she said that the small business segment, both debt and equity, are great right now. They're very healthy, and she said that it was actually she could not deploy enough money into small businesses right now. So in her perspective, lending is going great with small businesses, and the question was asked, okay, so how do you define a small business? And her answer was, a business between $1 and $20 million in revenue. That's in her category, business is great right now. Directly after she presented, the head of small business got up and said, well, I lend to companies with $1 million or less in revenue. And in my category, business is tough right now. Loans of $150,000 or less are down 27% since 2009. Small businesses, 1 million or less, are really struggling right now, whereas small businesses, 1 million to 20 million, doing really well right now. A lot of the platforms in this audience today are using technology and alternative sources of credit to focus on those really small businesses and help them with a pain point that's currently out there. And if you look at the small business category, there's a lot of different ways to lend, and both the interest rates and the duration play a big factor there. So you start top left, you have factoring and receivables and point of sale lending, really short term, very high interest rates, really interesting categories from an investment perspective. You move forward, and some of the players there are receivables exchange, market invoice in the UK. On the point of sale side, Bill Me Later's the granddaddy. Wouldn't be surprised to see Google enter the point of sale sometime soon. Affirm, which is the founder of PayPal, started Affirm. Merchant cash advance, a really interesting area. Capital Access Network, which is here today, owns about 50% of that business. Cabbage, which is presenting today, also plays a big role in merchant cash advance. You move on to short-term online lenders. On Deck, QuarterSpot, both really interesting companies in short-term online lending, which is somewhat similar to the merchant cash advance segment. And then you move a little further out, a little longer in duration. You get to a couple of years. Instead of 6 months, you get to 2-3 years out. That's where Funding Circle from the UK plays. Also where I think when Lending Club eventually launches the small business category, wouldn't be surprised if they kind of fall into that category since it matches kind of with the consumer lending right now. Foundation, Endurance, SomaLend are also in that category. And the large internet companies are also participating in small business lending. Amazon is looking at their merchants and cherry picking the ones that they really like. They have kind of real-time data on the merchants selling over their platform. They give them loans to help them purchase inventory. The capital must be used on Amazon services. Google has a credit card. They help their 3 million small businesses purchase more keywords on Google. Bill Me Later, obviously doing really well for eBay right now. They have a $2 billion loan balance at a 15% interest rate. Finally, big data. Big data and online lending, they kind of go hand in hand. We have a number of big data companies here today and a panel on big data. These companies are doing everything from looking at the asset side of your balance sheet, so kind of what you own, what homes you own, what cars you own, to looking at your shipping data, your daily P&L that they get from QuickBooks, your cell phone and your utility bills, and then of course social networking, your presence on Yelp and Foursquare, and those types of categories. Plus the government, the Treasury, we're down there, very interested in exposing SBA data and other forms of government data, kind of exposing APIs to make it easier to access that data. That's coming. All this data is out there these days, and there's a whole industry of kind of big data players that really interesting. They're going to help with the credit underwriting process, and something we'll cover later today. So finally, just to wrap up here, some of the key terms that I think you're going to hear today, of course, online lending and attractive rates, but better data. Data is so critical to a lot of the platforms that are presenting today. Use of technology, community. You're going to hear a lot about community today. I think it's very important, and the use of social networking to really help with both the credit underwriting decision, but also help the companies. The platforms actually help the companies help themselves. We're also really focused on high quality borrowers here today. A lot of times there's a perception that we're going after, that there's subprime or super subprime borrowers, and that's not necessarily the case. We're really focused on prime borrowers. Ton of growth in the industry, stability in investing, great yields, and real time. Everything's real time data, which is real key. And with that, I thank you for coming. The next panel will be the consumer P2P panel. Please make your way up here, and we can get you mic'd up. And if anybody wants to talk to me, I'll be over in the breakout room. Thank you.